I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, John Williams, economist John Williams at shadowstats.com. He's coming to us from San Francisco, California. John Williams, thank you for joining us today on USA Watchdog.
Thank you for having me, Greg.
Yeah, I told the visitors to USA Watchdog I had called you about the Baghdad Bob 3.9% revised upward gross domestic product number, revised to 3.9%, and I called you and said, John, I'm just getting ready to go on my weekly news wrap-up. Is it really up 3.9%? No, it's not.
No.
It's not.
Well,
explain that this is looking like Baghdad Bob. The lies are so overt, so obvious, and then on the heels of the Black Friday weekend shopping that didn't go well. One report I read down 11%. Tell me about the 3.9% revised GDP rate. Are we growing at 3.9%?
not that I can see, or anyone else that I know who's really looking at the economy can see, other than if you're trying to sell a bill of goods to the markets or the currency, specifically the currency markets. 3.9% is nonsense. You had 4.6% in the third quarter. In the second quarter, so here you've had 2 quarters that are close to 4%. We haven't seen anything like that since 2003. This is the strongest economy we've seen in 11 years, and I can tell you Main Street USA is not saying that. The GDP series is the most worthless one published by the government. Very simply, there's a big bias built into the system by understating inflation. But separately from that, we've seen recently some just horrendous bookkeeping that just doesn't seem to tie with much. A lot of this came from before the election. Specifically, you had a big revision to the gross domestic income, which is a counterpart to the GDP. Only it stays open an extra month in the revision, and the revisions there show that suggest that much of the upside revision in the GDP in the third quarter was due to a downside revision to the GDP in the second quarter, but they don't publish the revision to the second quarter at this point in time. You have to wait till next July. If you look at the real world, you look at the sales of the S&P 500, generally been flat to minus. So the third quarter sales of the S&P 500 contracted. If you look at the election results, forgetting just a general shift against the incumbents, which would normally indicate a weak economy, the voters who were polled gave a response that's consistent with a contracting economy. The economy's never recovered. The official version of the GDP is that you had a plunge in activity and then it recovered. It's expanding now. Again, we're seeing a boom that hasn't been seen in more than a decade. The reality, and you see this in a number of series, such as the consumer confidence measures, the economy plunged and then bottomed out at a low level. There's been some uptrend in some of the series, but generally there has been no recovery in the economy when you look at the series that are independent of inflation manipulation. And when I say inflation manipulation, that's because the government deliberately understates inflation. And in doing so, the way most economic series get reported, they're adjusting for inflation. Because if you want to see how retail sales did, you want to take the inflation out of that so that you know how the physical volume went up or down, not how much went up or down because of a change in prices. And if you understate inflation, which the government does, you overstate inflation-adjusted growth, and that's probably the biggest problem with the GDP report.
Well, over the holiday weekend, let's talk about 11% plunge over the holiday weekend. That doesn't even account for inflation.
No, that's just hard sales, and that is so. Even with the government's accounting and inflation numbers, you've got to knock 1.7% off of that to adjust for the government's headline inflation number. So when you can see what they call the real retail sales, the real meaning inflation adjusted, the year-to-year change will be 1.7% less than we're indicating now. And we put in a realistic number, which would be somewhere between 5 and 9%. It's much worse.
The real inflation number is between 5 and 9%, not
That's correct.
1.7%.
Yes.
And these gas, Gerald Celente came out and said, listen, you look at oil. I mean, the oil, I'm sure, is also being manipulated, as all markets are. But if you take a look at the gross demand for gasoline and oil, demand is way down, which is consistent with a declining economy. If you take a look at, consumer confidence levels that you brought out that said they're at recession levels, if you look at plunging home sales, if you look at, bond prices, are going up as interest rates are going down, all those are indicators of the economy tanking. And then take a look at our debt, 18 trillion now. We're now over 18 trillion. That's our cash deficit. And up 70%, according to one report, under Barack Obama. Is that going to get better, or is that going to get worse? Are they going to start pouring more debt into the economy?
Well, unless they can balance the budget, and I'm talking really balance the budget, we'll get to in a second, the offsetting factor there is increasing debt. The way the government accounts and the accounts for its spending in the popular press is just in terms of cash in versus what they spend, cash out, using generally accepted accounting principles, which accrue for expenses and obligations. What you're seeing is that the actual deficit, instead of being around, say, $500 billion this last year, was more like $6 trillion as it's been running for some time. So that where the gross federal debt right now is $18 trillion. If you add on all the net present value, notice what you need in the hand today to be able to cover this, of the future obligations, the unfunded liabilities, including the unfunded liabilities for programs such as Social Security and Medicare, you're approaching $100 trillion in terms of total federal obligations, and there's just no way that can be covered. And you'd have to have basically $100 trillion in hand today to cover that expenditure into the future. That's what the net present value says. That's how much you need in hand today. So the government long term is bankrupt. That's going to get worse down the road. And at some point, as most governments do that have the ability to borrow and funds and the money that they print, they end up printing money to cover this, to cover their shortfall and being able to raise the funds legitimately. And the effect is inflation, the hyperinflation. Right now, we've got a big distortion in the markets, which is the strength in the U.S. dollar. And there are a number of factors tied to that, but I contend the dollar should be getting much weaker, and that indeed it's going to turn very sharply very soon, and that'll be a proximal trigger for a major upturn in inflation. The reason the dollar is strong right now is that you look at the key factors that drive the currency relative to the rest of the world. Number one usually is the economy. This economy is booming if you believe the statistics, but Main Street USA doesn't believe the statistics, and I can show demonstrably that these numbers are nonsense. The rest of the world is in recession. Guess what? We're in recession too. We're just not reporting the numbers as accurately as the rest of the world. And as a result, right now we're getting a very positive play in the dollar. You look at government stability. That's a key fact, relative government stability, U.S. versus its major trading partners. With the change in control of the Congress, things are not getting better, at least they don't appear to be. It looks like things are getting more contentious. Very good surrogate for the political situation's impact. The U.S. dollar is the positive rating of the president. The lower that is, usually the weaker the dollar. It's basically at an all-time low now. The dollar is still strengthening. What's been happening here is the U.S. has made very deliberate efforts to boost the dollar, hit oil prices, hit gold, all factors that are aimed at providing some financial punishment to Russia for its exploits abroad. We haven't intervened militarily, but we have hit them with both overt and covert financial sanctions. And the drop in oil prices has been well orchestrated. It's not going to last. It's not fundamental. And at some point, not too far down the road, you're going to see a sharp swing in all these factors. Particularly as the dollar declines. When that happens, and there's heavy selling, oil prices will spike. So will gold prices, and so will domestic inflation.
Do you think that this economic war we have with Russia? I mean, Lavrov is on just like late last week, Friday. He was on last week saying that the tensions between, or Thursday, I don't know, just late last week. He said, yeah, you would not believe the tensions between Russia and the United States, that they are very high. And with a all-time low ruble, I believe it hit last week, all-time lows, and Russia is probably, they're not going to take that. They're not going to take their attack on their currency. I mean, couldn't they give us a pie in the face? Couldn't they do a variety of things back to us with economic warfare with their buddies China?
I wouldn't be surprised. The thing is, the Russians have been reported as selling the dollar, and that would be a way of supporting their currency. One reason we've been pushing the dollar higher is to damage the purchasing power of the ruble. Again, the system will balance out what specific actions they'll take. I don't know, but I would certainly expect that we're far from finished in terms of the back and forth play here.
You've been saying for a while that the beginnings of hyperinflation would start in 2014. Are you now looking to push that forecast back some? I mean, the fundamentals, as you have laid out, are certainly there. I mean, we don't have a strong economy, even though they Baghdad Bob the figures to us. Are you pushing your beginning of hyperinflation back into 2015?
Yes, I have formally pushed the hyperinflation forecast into 2015. In terms of the proximal trigger, in terms of what gets things going now, a massive decline in the dollar, that could happen anytime. It could still happen this year, but just given lead times and such, even a collapse of the dollar now would really not be reflected in the early stages of a hyperinflation until early in 2015.
Why are they making these? I mean, when you come out and say that GDP revision is nonsense, I mean that's pretty harsh for an economist to say to government figures. Why are they lying about? And I don't know how else to couch this. Why are they lying about the strength of the economy? What's the point?
Well, coming into the people in the Clinton administration, who surveyed how people responded to economic statistics. And they concluded that in a tight race, if it came out with better economic numbers, that it could make a difference in favor of the incumbent party. What I've found, and there have been times when there have been outright manipulations, the average guy knows what's going on. Main Street USA responds. You go back to the George Bush the first, his run for re-election versus Clinton. There was a manipulation in the GDP there that boosted the reported economic activity. People didn't believe it. The thing became it's the election, so it's economy. It's economy stupid. The people know what's going on. You saw the same thing happen in this election. I think the numbers that we had coming into the election, which included the first estimate of third quarter GDP growth, were most likely rigged to help with the election. It didn't help much, because again, the average people, if you're suffering financially, the pocketbook issue will dominate an election. And you can play with those numbers a little bit, but if people really suffer, it's not going to swing the election. That's what you saw back in early Bush era when you had when Bush lost to Clinton. So they can try and boost it, but otherwise, what they have is built in a system that adds approximately 2% per year to the numbers. That's tied to the inflation. It's much easier for the politicians if the numbers stay positive. It's easier for the Fed. They don't have to make these difficult decisions. It's a happy circumstance for Wall Street. Wall Street loves this. And a lot of that comes right down to how they gimmick the inflation. And why would they gimmick the inflation? There's a very deliberate reason behind that. It was expressed clearly by Alan Greenspan at the time, back in 1990, when they started to change the nature of the CPI from measuring the cost of living of maintaining a constant standard of living to something that reflects the ability. As steak gets expensive, you buy more hamburger. Your cost of living is lower. That was Greenspan's rationale as to why the consumer price index is overstated, which is one way of looking at it. But traditionally, the way most people look at inflation, I want to maintain a constant standard of living. How much do I have to increase my salary by, or what's my minimum target base for investments? I want to stay ahead of inflation. I want to know what's going to cost me to maintain my style of living. And the old CPI measured that. They changed it around, saying that the old style overstated inflation, and by one definition it did. But not by definition that means anything to people who are looking at this as an indicator for income and investments. And so you ask them why, how is it overstated? It wasn't substitution based. It was the wrong way. And the issue here came down to, well, okay, so what are you going to do with this? He said, if only we can get a better cost of a better CPI measure. When it's got a lower level of inflation, we can cut cost of living benefits, costs of that, the government, for Social Security and such. It'll help us to balance the deficit. And that's why they lowered the inflation rate. And it's partially due to that you see increased overstatement of economic growth in the official reporting.
So you think there's going to be a big turnaround in the oil and in gold in 2015? Why? Explain.
The issue remains the dollar. What's distorted in the system right now is the dollar's strength. It's as strong as it's been in some time. It's overstated for all sorts of reasons, ranging from outright manipulations to very specific overstatement of economic growth, other games that are being played. That's going to reverse sharply. Now, as the dollar sells off, you'll see inflation pick up. As the inflation fears oil prices will rise. Gold will rise in response. Part of the reason that oil is where it is and that gold is where it is because of the dollar strength. Back when Bernanke was saying that he wanted to address the fear of deflation by creating inflation, by debasing the dollar. He introduced quantitative easing. We did succeed in getting some selling pressure against the dollar. Direct response to that was higher oil and gasoline prices. It gave us inflation domestically. But the thing that's crazy here, and this whole scheme of things of trying to keep up inflation, is that a lot of people view inflation as meaning economic growth. There's two ways you get inflation. The happier way is to have a strong economy, strong demand, factories are running overtime, people are working extra hours to meet this extraordinary demand. Prices rise. Although there's an inflation there, and good reasons to try and avoid inflation. That's a relative circumstance. You have a booming economy. People are employed, they're making money. People can live with some inflation. We have another type of inflation, which is sort of a cost push, where the oil prices rise, for example, because of some kind of oil cartel action, or in the case of weakness in the dollar, the price of oil and gasoline being driven higher by the weakness in the dollar, not being driven higher by strong demand. Then the average guy finds that his money doesn't go as far as it used to. His disposable income has been into because he's got to buy gasoline to go to work. That's not a happy inflation circumstance. That does not reflect economic strength. And what has been done here to boost inflation, and what they're still talking about doing in the rest of the world, is the negative type of inflation that they're looking to create. That they can't create the positive. It's very difficult to stimulate the economy in this type of a circumstance. We're still living in the throes of the panic of 2008. All the central banks did at that time, specifically the Fed and the U.S. government, the U.S. Treasury, was they took action that pushed all the issues into the future, but they didn't do anything to solve the basic problems. The economy is still in trouble. The banking systems come back from the brink, but still the banking system globally is far from solvent, far from normal. You're not having regular bank lending. If you had regular bank lending, the U.S. economy really would be much stronger, but it's not. The banks are not fueling the recovery the way they usually would.
And you've said when you start selling the dollar, and people know a lot. You're one of the only people that bring this up. Is that the outstanding liquid dollar assets and dollar assets outside held by foreigners outside the country? You've stated in the past it's at least $16 trillion. Is that where this sudden turnaround comes, where people just say, "Whew, America's in trouble. Well, I'm selling everything. Treasuries, dollars, bonds, whatever."
People outside the United States know America's in trouble. They know the dollar's in trouble. And it's not going to take much to trigger a reversal of the current circumstance. It could be an unusually weak economic system. Believe me, those are coming. The underlying economic theories generally are not supporting the strength that you see in the GDP. Industrial production's been weak and weakening. Retail sales are soft. There's been a sharp slowing in growth in most of the popular indicators, but you're not seeing it yet in the GDP reporting. Again, the GDP reporting is largely fluff, and I have not found that it has much of a relationship to economic reality in recent years.
Are they going to bring back QE4? Are things going to get so bad at some point, do you predict they will say, hey, well, we tried to get the economy going, but we're going to start buying bonds again or printing money or QE4 or whatever form it takes?
Well, that's why a weak economy now, or a surprisingly negative economic system, let's say the employment numbers are much weaker than expected. That will fuel the speculation that the Fed is going to come back into play here and keep supporting the banks, keep supporting the system, keep supporting the Treasury. I mean, if you look at the actual cash deficit last year, the Federal Reserve bought most of the funding for that. They monetized the debt. It wasn't sold to the open market. It was sold to the open market, but the net effect was the Fed took out of circulation the same amount that the Treasury was borrowing. It's the pullback on the quantitative easing, the promise now that yes, we will sin no more. We're going to be very pure and simple with our monetary policy. We're not going to be overly aggressive. We're not going to be monetizing the debt, and that will disappear. They're going to have to come back and do what they were doing before, and the reversal or the expectation of the reversal in Fed policy there will be a major factor behind the sell-off in the dollar.
What do you say to people that say, "Oh, we're headed for a deflation. We're headed for a higher dollar. You know, dollar is going to be good to hold. Dollar is going to get even stronger, and we're going to have deflation. We're not going to have inflation or hyperinflation." What do you say to people with that mindset?
Well, there are two areas there. In terms of the economy, we believe we're seeing the strongest economy in 11 years. God bless you. And I mean, there are some businesses that are doing well. The average guy is not seeing it. And there's a wealth of evidence, and I've been writing about that. People can see that on my website. In terms of deflation, the decline in oil prices has the effect of, and lower gasoline prices will have the effect of reducing the official inflation rate. We actually had a small deflation given the headline numbers. It was down 2-3%. Year to year at one point during the crisis. Again, it had nothing to do with what was happening other than whether gasoline prices were going up or down. If you add back in the changes that the government has made to the CPI reporting to make it no longer the measure of an uncanny and constant standard of living, but the substitution-based creature that they've come up with that doesn't even reflect your out-of-pocket expenses. The difference there more than accounts for the drop in the official CPI. We never had a shallow deflation in the post-crisis, the post-2008 panic period. Even though it shows so in the official numbers, again, the official numbers showed inflation that was well understated. Going forward, to have a real deflation, to have the type of deflation that Bernanke was scared of, you have to have a collapse in the money supply. What happened back in the Great Depression, this is what had some people scared, was you had a failure of the banking system. And it's a failure of the banking system. Banks fail, and there's no FDIC. Whatever money you had with the bank, if the bank went out of business, you lost your money. And as a result, as the banks failed, people lost the money they had on deposit with the bank. And the money supply contracted by about a third. And in aggregate, you had a decline in prices with about a big deflation. The economy dropped by that order of magnitude.
And now?
And now you have things such as the FDIC and if the 2008 panic is any indication of what would lie ahead here. At the time of the crisis, the afraid of the collapse of the banking system, they guaranteed everything. It didn't make any, it didn't have to have, there was no certain limit on the FDIC. All accounts, all amounts were guaranteed. Everything was guaranteed. They created whatever money they had to. They bailed out whoever they had to because they couldn't let the system fail. They're still in that position. They won't let the system fail to the extent they can still create the dollars to do so. And as long as you don't see a collapse in the banking system where the funds disappear, you're not going to have a 1930s style inflation. I mean, otherwise, you can argue. I mean, the argument would be, well, right now inflation is pain, oil prices dropping, maybe you see inflation come a little lower. That's fine, but this is the inflation numbers that you're seeing are at this point still well understated. Again, you should be in the 5 to 9% range, not in the 1.7% range that they're reporting.
And you're saying that if we get into trouble again, it's going to be 2008 all over again, except on steroids, worse?
Well, they don't quite have all the options they had back in 2008. It's not going to be easy. I don't see it. I don't see it working well. And again, the big victim here, what you got to watch out for is the dollar. The rest of the world says, okay, look, you had a chance to pull it together, it didn't work. We're going to protect ourselves. You're the guys that are leading us in this horrible unending debt expansion. I mean, again, $100 trillion net present value of our federal obligations, including those federal debts that just topped $18 trillion. That's they're going to dump the dollar, and that's what triggers the hyperinflation. And then the dollar becomes worthless, and you end up with a new system, and that's all been discussed. And there's still a hyperinflation report on my site for anyone who wants to read it. Upper right-hand column of the homepage, it goes into the detail on it.
I will be linking to your homepage. You also do a subscription service where you get into highly detailed stuff. We just kind of scratched the surface here. Your reports come out a couple of times a week. I think it's $175 a year.
Yeah, and we also offer a 6-month subscription for $89.
I'll put your homepage on with your name at the beginning of the before the interview and your subscription service at the end, and I get a free one because I'm a journalist. But you have very detailed reports. Some of the biggest people who handle money in the world. You read your subscriptions. I know your client base is secret. John Williams, shadowstats.com. Economist John Williams at shadowstats.com. Thank you for joining us today on USA Watchdog.
Again, thank you for having me, Greg.